Volume analysis. Let's talk about the foundational guidelines for volume analysis. And these are the ideal, of course, but as we go through the charts, we will review how they change at different times, or maybe not exactly the ideal. One of the things that I've worked on making things more simplified for you is to understand that things are not always the textbook exact type of situations that you do learn in a textbook. We do have to know what the ideal is, and then we adjust from there because trading requires you to be flexible. So volume increases should occur in the direction of the prevailing trend. And in other words, as prices are going up, we want to see that volume is increasing, and vice versa on the downside. There's that confirmation that there's that participation that's happening in the direction that prices are going. We want to see volume decreases occurring against the direction of the prevailing trend. So as prices are pulling back within an uptrend, they pull back on lighter volume until they reach an area that we are focused on. And that would either be minor support or major support. So we want to see that volume increase in those areas. And as it gets there, that shows that there's confirmation and an increase in interest. Now, when we see volume increases with price contraction, right, the ranges are getting smaller while the volume is increasing within the prevailing trend, it's a warning of a potential reversal. So when I look at volume, my primary focus is a spike that is different from what the norm is in the moment. We can't really put a number on that. We don't have to, because different instruments have different, let's say, normal volume for that instrument. However, the spike as it relates to whatever you're looking at will be obvious that it's much larger than what it has been. So climactic and committed volume, what is that? It's a very large volume spike. Right? So a climactic volume it's clearly obvious. It's a huge bar, relatively huge volume bar. It just sticks out above all the others. And as I said, we're not interested in really measuring it. It's visual in that we see that it is 2-3 times, probably 3 or 4 times the size of a normal volume bar. Above average volume means just that, above average the norm. We don't want to get too scientific. It's visual analysis, and volume works most times. Meaning, if you see a spike, there's a lot of activity, let's just pay attention. And from there, we have to apply the other concepts that we've been talking about or will talk about. And location is one of the primary things that we need to focus on. Meaning, if that volume spike is happening, does it happen as prices approach an area of support? Does it happen after prices have been moving in one direction for an extended period of time? Does it happen after prices are moving in a direction and then on a gap? And volume, for me, is an attention getter. I don't focus on volume indicators. Of course, I don't use indicators at all. However, my focus is not trying to massage the data, if you will, to tell me something more about what's on the chart. It's just there for me to look at. So climactic volume can indicate capitulation at the end of the move, as I said, coming after an extended move or after a move and a gap down. However, committed volume ignites a move, similar to a wide range igniting bar. Now, while that would be the ideal to have a wide range igniting bar with igniting or committed volume, you could get a move out of a base or consolidation or after a retest and failure type of a pattern where prices are coming out of that type of corrective pattern on committed volume. So we have the ideal, big volume bar with a lot of volume. But if it's a smaller volume bar or larger than normal volume bar, ideally you want to see some range expansion with volume expansion at the same time. Now, you don't place trades on volume alone. Right? It's a secondary piece of information. In reality, we could trade without volume. Meaning, as long as I know that something has liquidity, whatever that might be, a stock, a futures contract, a currency, as long as I know that there's adequate volume for me to enter and exit with relatively ease, the volume is a secondary piece of information. Price is going to tell me when to trade. But however, a volume spike at times can precede a move. So it can be an alert mechanism to say, pay attention. As a price has to confirm in the form of a reversal candle. Let's look at a few examples. Here the trend was down, and we see prices, we see where major resistance, it was never overcome. So as we follow this to the downside, and we're going to look at some other concepts. So here I got a green bar ignored setup right here, and then prices moved down below that low, which was bearish, and then it consolidated below it, drops, and then it drops, and here's your area of resistance that on the retest, note the topping tail, and then the move underneath here, and then the move down, and then a nice little sell setup right here, and a move lower, and we have that happening on a above average volume or a bit of a spike there, and we get some stabilization after that, and prices move up into that resistance area where now that supply comes in, right, at resistance, and prices start to chop sideways. And look at this nice little breakout failure shock. This is the money. When you see this type of a pattern in alignment with the bigger picture, we talk like the trend, the direction of the trend, is there a void? These are your bigger picture concepts. A candle pattern is a small part of the bigger picture. So when we take that small part and we put it in the context of trend and resistance and void, and then the emotional shock of what happened to traders, it's just a huge opportunity to take advantage of it. Now, on the move down, here's a big volume spike again. So we pay attention. Now, of course, the gap down would have gotten our attention. It's a daily chart. The gap down would have gotten our attention that there should be some profit taking on the short side. Gaps after several bars moving in the same direction, it's normal to get a counter move. And this retraced up into this minor resistance area. Think about what would have been even more bearish than that. An inability to move up toward that resistance area. And you remember from the prior section that we talked about, after a climactic type of a move, and this is like what I would call a mini climactic type of a move, your best setup is going to be, well, either here or you get the shallow retracement and then a retest pattern, because you still have that void above, but this creates a resistance area below that area. So as prices move down, the volume stays relatively steady. Note that topping tail right there, so we get a secondary sign of strength. There's a void below, and at this point we get the next drop, and here we get a range contraction. Right? There's range contraction right here. The range is contracting as the volume is increasing, which indicates that there is some buying happening. The trend is still down. We're not interested in longs at this point. Right? We're paying attention to what's happening here as volume spikes. Note the bottoming tail bar, this little retracement, and then the move back down again, and so on. Volume spikes above average and climactic must be paid attention to, of course. So here, volume spikes up a bit as prices are moving higher. Well, short term, say, well, here is, probably the end of this move short term. Multiple bars moving up, a topping tail bar. Now we'll get into moving averages, but we don't have moving averages on here. But let's assume for the moment that this came out of a consolidation or base, and our moving averages would be just turning up here. That would suggest to us, and especially if there was a void above, that prices could continue higher. Now here's your void concept, and prices could pull back, but as we look at where support is, it's down here, and a retracement all the way back down to here would not be ideal. The ideal situation is for this to create support. And remember, we talked about pivots, and we don't have a 3-bar pivot here, because this one is a lower low. So we've got 2 bars to the left, and we've got 3 to the right. And that's why I said, you have to be flexible, some common sense, but this is not a pivot of significance. However, we will take note of it. And then as prices came down to it, and then they broke it and came right back up again and start going sideways. And we haven't gotten into these concepts yet, but I'll point it out to you so you're thinking about it already. But we have a tiny little shakeout pattern right there. And this is a great little pattern here to be buying. So you've got the shakeout, it shakes out the weak hands, and hits some stops there, and bounces right back up, which tells us that there's strong demand. And here's prices move back up again. Here's that gap, and look at the volume on the gap. There's some profit taking there. It's short term, and we'll get into position management here, but you're going to have to resist exiting a whole position, not against exiting part of a position here and then potentially adding to it at the appropriate time. But notice how bullish the action is here with this 180 type of reversal, and then a little sloping move to the downside and up again, a break lower. So we're looking at these continuous bullish confirmation patterns that are happening, and here and here. Wow, there's some damage being done. A lot of volume on to the downside here. And so we've got a short-term reversal. And at this point, we could, I'm going to forget this here, we could at this point on this break, as it broke through support, the gap up and failure and reversal here would be a short setup. And this is the type of situation that you will encounter as a real trader and or swing trader or investor, meaning a bearish scenario here and selling it short. As it comes down to the next support level, we have to pay attention. So this bigger pattern here, while it would suggest getting below it, here's a situation where it didn't. So we have to have rules and be objective about what's happening, and we could have a stop here. But the retracement all the way back up here is definitely a concern, and the fact that this did not result in a break at least below that low, you need to be paying attention to that. Let me just clean up this chart here for a sec. So here is a run up and a big gap on a big volume spike, and that is a bearish gap down. And we just continue the process and doing our analysis as I've been explaining to you. Now, for day trading, there has to be sufficient liquidity, of course. And one of the quick, easy ways of doing that is once you have your interest list from your daily time frame, you look at a 5-minute chart, and if you see something that looks like this with gaps and dots and dashes, kick it out. That's not adequate volume. For day trading, we need enough volume on every 5-minute candle to tell us that there's sufficient liquidity. And this is the type of chart that you want to see with volume like that. Large gaps on huge volume signal a further move in the direction of the gap. A lot of times prices will retrace after the gap. It's common on bigger gaps that you get retracements. So here you had a gap down, a pretty bearish gap down under support. But on a short-term basis, it rallied back up into resistance, and then it moved back down again. And here's the pattern as it played out with a little retest double top here before it went lower. And here you've got some above average volume as it moves down. As prices move in one direction for an extended period of time, and we just look at this as really, well, it was a stall. This is all one big move. And then the volume increased, and notice the gap down here. And then prices retraced up into resistance where traders, hedge funds, etc. now feel more comfortable exiting positions or putting on possibly a short position. Right? Prices move between reference points, in this case of resistance, and where there's support. And so here, red bar, gap up, and buyers begin to step up here. This is not the type of pattern that we want to buy, especially from a daily time frame as a swing trade. There's a lot of uncertainty here, based on this pattern. The retest of support, this is certainly not where you would want to short. But notice, there was this volume spike here, and, well, look at this big, huge gap up here. When you see something like this, it's either news or possibly even an earnings report. So think about earnings reports coming out and knowing the earnings calendar. Unless you're holding something long term, you're not going to be putting on short term positions ahead of earnings. Holding something long term, you certainly want to be considering using option strategies to hedge yourself in a situation like that. So here is a chart that we actually looked at in a prior section, and here you have the move up with increasing volume, and it backs off a little bit on this consolidation, which is ideal. And now we got a volume spike here with this little topping tail, and notice the wide range bar. Right? We say that a wide range bar ending, and then the volume, there's your extra confirmation there. And notice that also this range contracts from these prior candle ranges. It contracted with huge volume, and then as prices pulled back into this little area of minor support there, and notice the gap down, the spike on volume as it moved down. So is that committed? I would say absolutely yes. But I put question mark here because we know, in 2020 hindsight, what happened here, however, there was no confirmation in that prices broke down again. So when we look at a situation like this and say, well, here was this bearish gap down on committed volume. It broke through support. And of course, I look at this pattern and think, well, how can I profit from that? Well, here's an inside bar. And another one, I can profit from that by selling it short. But our method is one in which it is required to break below a prior bar's low to enter a short position, and vice versa for longs. It never happened. So our method of entry here actually saves us from shorting at this level, whereas another method might just say that's bearish, sell it short with some money management technique based on either a dollar loss or possibly, a move up above this level would stop it out. But here would be a place to actually consider a short position since it's at resistance. You've got topping tails, and we could enter at this point here, and the trade would not have worked. However, not every trade is going to work. Committed volume, wide range bar igniting, and this consolidation here at the top of that wide range bar on declining volume is ideal. This is a great pattern. It's one to take note of, put it in your journal, print it out, put it on the wall, stare at it every day, because this is a money pattern. This is creating support here after an igniting bar with committed volume, with a void above. Can't write very well here, but you get the point here. And then looking for the move up. So what we're doing here is building your knowledge of various analyses concepts. And as we put them together, that is where the high probability criteria comes together to find great trading and investing opportunities. So trending lower for a period of time here. I mean, trending down, lower highs. Notice the gap down here. Where's the volume? So it can happen without big volume. And that's part of our point here, that volume is secondary. Trend is one of your primary focuses. Volume is a secondary piece of information. Now, as the volume increases, of course, you're going to pay attention. It's larger than what it was here, but it's certainly not climactic. This is what we would call climactic. Look at the size of that volume bar on that gap down. So, thinking that this is an exhaustion type of a gap is a normal or type of analysis that we would look for possibly some stabilization, and it happened, but it continued to drop there, and it never was able to really stabilize in a significant way and move up at all, which tells us that the supply, the selling, which in a case like this is institutional, that just keeps selling and selling and selling and driving it lower day after day. In addition, notice the range of these candles. There's no wide range candles here, which tells us that the selling is not only institutional, it's systematic. It's actually programmed in that not to drive it lower in a fast, extended way, because there's so many shares for sale that they have to unload to get rid of, that they know better than to just dump it. And what they will typically do is at the end, say they give this to a market maker to exit a large position. Well, the market maker will dump a large amount of shares at the end of the move. And what they do at that point in time is they take the other side of it, meaning the market maker will take it in for his own account, knowing that the supply is exhausted at that point, and it'll move back up at least for a short period of time, and they can profit from it. So, here's the bottoming process that starts after the above average volume, and it's more of a grinding kind of a move higher versus one that starts with a wide range bar up or a sideways consolidation and then a wide range bar up. We talked about gap reversals. They typically do happen with a volume spike, and we want to pay attention. Right? Doesn't mean that the trend necessarily is over, but we want to pay attention. Volume spike, big red candle down, and of course that creates a lot of uncertainty, big red candles on big volume. And here this what we called repairing the damage. A pivot forms, you get a retest at another pivot, creates a larger area of support. You've got low volume, but it happens, and it moved up on that low volume up into this resistance area here, where we know there's going to be sellers on revisiting this very bearish price action. Back down, gap lower, big volume spike again, retest, and the whole process, as you can see in our analysis, is one in which we just repeat doing the same things over and over again. We just apply our method, our techniques, our understanding of price and volume action, and a gap down on volume, we're thinking possible stabilization. Your next thought should be, where is this happening? Is it an area of support? Is it retesting a prior reversal? When this pivots, when it comes down here again, what happens? In this case, it formed a bottoming tail bar. And then it begins to stabilize again. And, it's just the process of ebb and flow and moving back and forth. And in this case, it's building up a wider base here. But one of the things I take note of here is the whippiness and volatility that's happening here. Not right here, but at these ends here. Look at the size here, and the move down and the move all the way back up. Whereas over here, that volatility is beginning to contract. It's getting a bit tighter. We're still really not interested in this pattern, because it's kind of all over the place here. It comes up and consolidates and actually looks like it could go higher. Note this green bar here, this little downside shakeout. It never clears these highs, and it gaps back down, which is bearish. And now as it retests the prior low, right back up again, this is where we're interested. Big volume spike should get your attention, and here it cleared the resistance. It does have this void. After looking at this, you look for ways of entering. Another daily chart. How do you enter here? Well, in reality, there is no clear pattern here, and this is where multiple time frames really shine and help you to get into a situation like this, where we could use an intraday time frame with the proper money management to enter on this day. And of course, this reversal right here tells you that, this could be a entry point on this move down and 180 reversal back up. That being said, you certainly would be looking over to the left here to make sure that there's a void. Money management would dictate smaller positions with larger stops because of this void below as well, but we'll be getting into that. So here's an intraday chart, a 5-minute time frame. Here's a move down and a retracement back up on huge volume. And this is where someone with a big interest, let's say, or use of volume as part of their analysis might get caught up into overweighting the volume here over the price action. The breakout failure that occurred from this base, and then the igniting bar down. So as I say, the trend trumps a volume spike reversal. So this reversal back up, looking at the volume here, I have to give the respect to price, right, versus the volume. So as it comes up into this area of resistance, and I see topping tails, and I really like this pattern here because I've got two topping tails, which tells me if I was to look at, say, a 2 or a 1 minute chart, I've got a little base and little breakout failures up here, right? Not exactly something like this because this was going up for several bars, but this bar here, let's just call it these 3 candles right here. And if we were to look inside of these, we would see something like that where it stabilized and it popped up and it came right back down again. It could have a little base where it popped up and came right back down again. So that's how we're going to utilize multiple time frames, one of them anyway, where we would take an X-ray into a smaller time frame with a bias from a higher time frame. Some concluding thoughts on volume. It's money. That's why pay attention to it. It's money that's coming into and out of a tradable instrument. So the best looking charts, they're not going to move without volume. Traders need to be interested in what's happening there, and we have to make sure that there is that adequate volume, especially for day trading. Daily levels can be misleading when it comes to intraday trading. So as I said, you have to look at those charts on the intraday time frame to make sure that there's adequate volume there. It represents commitment or the lack thereof to price movement. It can be a confirming piece of information, right, to the candlestick analysis. It's the price patterns that we trade. It's not volume. As I said, volume is secondary, but it's more of an alerting mechanism to pay attention. Especially for those of you that are intraday traders. There's a lot of information that you're processing at that time. So to pay attention to the nuances of volume, pulling back on lower volume, and so on. You may not be able to do that if you're looking at too much information. If you're looking at one time frame, probably you can. However, the volume spike will get your attention, and that is the primary information that we want out of the use of volume, to pay attention to big spikes. If volume is coming down and it's beginning to accelerate to the downside, and ideally you're holding a short position and your emotions starting to say, hey, this is fantastic, you see maybe your P&L increasing, but you have to bring yourself back, or something has to bring you back to the method and the techniques, and this huge volume spike occurs, and it clicks. I better start on getting out of some of this position here, or tightening my stop. I better look to the left to see if I'm coming into an area of support. We haven't even really talked about the markets yet, but even to think, are the markets getting climactic to the downside? Are they in an area of support? Has the markets been pulling back over the last 3 or 4 days and now on top of a rising 50-period moving average? So there are different things to pay attention to that can alert you to a possible turn, either as prices are moving down or moving up. Lastly, candles represent supply-demand relationship, and volume tells us the magnitude of interest at those levels. I hope you found this all helpful, and I've added a lot of other thoughts about the price patterns as we looked at this, besides just the volume. And as we go through this information, I will continue to revert back to what you have learned to reinforce that information. And by the end of this course is to make this as much as a secondary part of your thought process as I can possibly do during the time watching this course. You will watch it multiple times, and the repetition of that will definitely make it secondary, and then you studying the charts on your own in real time and keeping notes and so on, you will become a master at doing this. Okay, let's continue.